And Frank, I'm not sure if you meant covered calls on this. I think you mean just buying calls. If it was covered calls, we'd do sort of a tangent into Ra's question there. But let me know, Frank, if you're talking about call buying or covered call selling. Frank's basic question is which call makes the most profit, in the money, at the money, or out of the money? Well, let's just go ahead and take on the monthly picks of the day for covered call. There's only one here, LW, that matches Ernie's criteria. The stock's at 84.95, and it's the 75 strike. It's in the money for the covered call position. Weekly picks of the day, same thing. Chewy at 34.07, a 32.5 strike, in the money. Avis at 171.19, in the money covered call 162. Why are we seeing in the money covered calls here? It's not that the in the money covered call will give you the highest return. It's that over time, having the better protection in place and more consistent success rates with a higher probability, in the money covered calls tend to outperform the same stock criteria with at the money and out of the money positions. Yeah, in a raging bull market, like let's say 2019, for example, or maybe 2020 after the March 20 decline, those large movements, out of the money covered calls would have given a higher return and you probably couldn't miss. Now, you are actually asking about long call positions. And so let's go ahead and add long call. We've covered this recently. I just can't remember the webinar off the top of my head, what the webinar name was, Frank. But going into just call buying a call, having unlimited upside and having a known risk. I'm not going to say a low risk. We might address that in a moment too. That was related to the question that came in via email that I'll do later because I didn't have time to put the slides together. But it's a known risk based on what you pay for it, but you're still risking 100% of what you pay into the call option. You've got to be careful with proper position sizing so you're not risking too much of your portfolio. But just like we saw with the naked puts, just like we saw with the covered calls, I got a stock trading at 50. I can buy a 50 strike call. I can buy a 55 strike call. I can buy a 60 strike call. I can buy a 40 strike call. Which one is going to give the best return? In our experience, going just slightly in the money, one strike maybe below or so, usually yields the best return in normal market conditions. Hey, Frank, what do I mean by normal market conditions? I mean seeing stocks move up, let's say, 3 to 5% in a 30-day period, or maybe even 2 to 4%. But in that range, you're buying a call because you're bullish on a stock. You think it's going to move up in price, whether you're playing in earnings or whether you just think the stock's going to move up. Your expectations might be higher. It's 7%, 8%, 10%. That's fine too if that's your expectation, Frank. But in most market conditions, you see a movement of maybe 2 to 5, 2 to 4, 3% or so in a 30-day period, and the slightly in the money ones usually show the best returns. The slightly out of the money options might not show a consistent return because the stock didn't move enough to get to that strike price to result in a profit. So we were looking at CCL as $7 stock. I want to go a little bit higher for more room. We saw the covered call on Chewy. That was also in the naked put. Let's use CHWY as an example. And what we're going to do under the long call is go into the long option finder tool. What this tool allows me to do is evaluate which option would give me the best return if the stock had my projected movement. And so I'm sorry here. Let me go back to another Power Options window. I forget. I thought it was 42.97, but I want to make sure I have that right for us all here before I go the wrong way. All right. So I know you're not seeing the screen yet. There we go. All right. CHWI. Let's just take a look at the quotes page. Oh, wow, it's way off. Thank God I looked, huh? 32.99. Let's call it 33 even, okay? Let's say we have a 3% movement on the position. A $33 stock be 99 cents. Let's call it $1. That's a 3% move in the next 15 to 20 days or so. So we're going to move up to 34. Let's go back to the long option finder. Our expected price of the stock is $34, 3% movement. Let's put $1,500 into some options. And our expected date Happy Halloween. Just use 1031. Now, naturally, all the expirations are going to be after the date I selected, because I selected that I think it's going to hit this target on the 31st. It's not saying any time around there, Frank. It's literal computer looking at 31st, and Happy Halloween. So the 28th expiration is not going to show up. What do we see here? It's all the in the money calls with only a 3% movement that are showing any type of return, assuming, of course, using the same volatility that we have right now, implied volatility. This might have earnings coming up between now and expiration, so it might be inflated. I know it's only a $1 move, but that's 3%. Why didn't the 35 strike show up? Well, because the stock didn't hit that price. It's going to lose that time value over the next 20 days that we paid into and not give us a profit. We'd need a much bigger movement. Let's go 5%. And oh, sorry, what the tool did, Frank, my apologies, is in that brief moment when I hit submit, it looked at the entire option chain for Chewy. And it did the Black Scholes calculation for what each option would be worth if the stock hit my target price on my target date and arranged it from highest return to lowest. There's some inflated premium going on here as well. Now, are these prices accurate? Well, we're looking at a 25 call for November 4th. If the stock's at 1031, if the stock's at 34 on October 31st, a few days before expiration, a theoretical price of 9. Exact intrinsic value plus 1 cent. That's very realistic price to target in this case. Okay, but let's go with a higher movement. Our stock's at 33, 0.5% movement, 165, 170. Let's do 170. Really small movements here, but let's go ahead. That's a 5% move. It goes up to 34.70. Same price, same same investment amount, same target date. And again, the only out of the money call is some aberration. We see 217 days out in time, but the returns are still moderate. Well, the implied volatility is 0.93. We might want to use this on it. We'll use this on Apple in just a moment as well. So again, where we're still in the money, I want 10% now. Let's go up to 36.30, a 10% movement on the stock. And so now we start seeing some more at the money calls with this very high implied volatility. That's sort of the answer to your question. Now, these aren't the numbers you're expecting with a 10% movement. I know that. It's because these volatilities are so high and the extrinsic value on these options is blown out of proportion. That's why I want to use Apple for the next example. But you see what's going on here, Frank. Consistently, the slightly in the money ones with a normal market movement of 3 to 5% are going to give you the best return consistently over time. If your expectation is a 7% movement, you're probably going to be closer to at the money, maybe slightly out of the money. And if you expect a 10% movement or 15% movement, you're playing earnings or something along those lines, then an out of the money option would give you the best return. The out of the money options, remember, it needs a bigger movement to get to what you need, even though it's a smaller cost. This is, yes, Jim, is it? James, okay. The James comment is, but you don't know what's going to happen at any time between now and the date you're selecting. That's right. This tool just looks at that date. We could use the profit and loss chart to analyze what it would be. In other words, if Chewy did run up 8% before the 31st and then came down to just being up 4 or 5% by the 31st, we're going to see different returns. That's not what this tool is doing. It's looking at your expectation. You are buying a call because you have an expectation that sometime in the next 10, 15, 20 days, your stock is going to move up X%. And this tool is helping you to give you a better gauge of what's going to happen. Your comment, Frank, so the out of the money 33, well, the stock, remember, initially right now is just at the money. It was $32.99. You say will not give a better return. According to the theoretical prices, no. And that's because of another reason. Just like we talk about with the married put approach for radioactive trading. Let me get a different color here that shows up better. We'll just go standard green there. And let me erase all my drawings. There we go. Okay. So the at the money bell curve here, when we buy a married put, our stock's at 33, we're going to be slightly in the money. 35, 36, 37 strike, not with these volatilities naturally, it'd probably be higher. But in any case, the reason why we're doing that is if you look at any option chain, and this is for a put, but this would be OTM for the call, of course, Frank, and this would be ITM as well, lower strike prices is what we're looking at. This has the higher price, but most of it is intrinsic value. The option that's closest to at the money always has the highest time value. When you buy into it, you're buying into the highest time value of that time, which means it's going to have a more rapid decay of time value between now and your target date. So you're going to need more of a movement to counter the time value you paid at this higher position. This is why we suggest going slightly in the money. And if you have a bolder outlook, more bullish outlook for the position, you could test slightly out of the money. But that's why you're not seeing, this is the closest at the money one we saw, the 32.5. Yeah, these returns are all pretty much the same, 32, 33, 36. But the 33 with the peak time value is not showing up. And this is not a bad example at all. This is perfectly illustrating what I wanted to show in that case. So, all right, and you said, but you can buy more. You can buy more out of the money contracts. Yes, Frank, you can buy more out of the money contracts because they're cheaper. But if the stock doesn't do what you want, that just means you're losing more money because that option's going to zero very quickly if you didn't get the 5 to 7 to 10% move that you needed. That's why, are we talking about the highest return? Yeah, if you see a 10, 12% movement, the out of the monies would give you the highest return, and based on what criteria you're going to put in, you see with the contract sizes we could buy with the amount of money I put into these positions, right? The slight closer to at the money ones are allowing you to buy more contracts for less of a price, but you're paying a low time value. So that doesn't mean you're seeing the highest return in those cases. And we're not even out of the money yet because of this high volatility. As I mentioned, let's do our quick run. Similar process with the Apple position, lower volatility naturally. So we'll see more returns of what we were expecting here. I don't even know where Apple is right now. Okay, let me try this again. Okay, there we go. All right, so Apple is currently at 138.38. Okay, I'm going to call it 140. So a 5% movement is going to be $7. So let's go ahead and say the stock is trading at 147. What are our prices like here? 227. Good. We're going to keep the same $1,500. And we're going to go back to Happy Halloween. Okay. All right. So what are we seeing here? The stock at 138, we're starting to see with a lower volatility, normal volatility, a 5% move, we're seeing now the out of the money options giving a better return. On Shui, we didn't see that because the implied volatility was too high. You just needed a much bigger move. So yeah, a 5% movement, $7 on the position. These are the these are the options that would give the best return, but they're all far out in time for some reason. So I'm wondering if they have a wider bid-ask spread. Let's do just a normal. Let's go to 7%. That would be at it's really 150. It's 149.80. Let's go ahead and do 150. I know why. Maybe I am wrong on this. Go ahead and submit that. Yeah, okay. I might have to increase the price. We might not be able to buy contracts closer in due to this didn't have the right price set in there. No, they're still doing this. This is interesting. So it's not giving me the near term options in those cases, and I'm not sure what I'm doing wrong here. I'm not doing anything wrong. It said only show actively traded options. Let's take that out. I'd still want to keep that in normally, Frank. I'm sorry, this didn't go as well as I had planned for the second example. Now we're all still 98 days out in time. Okay, it's 63 here in December. So that's with the 7% movement up to 150, and you're seeing the out of the monies. But again, if I only took up to, a 3% movement up to say 144 or so, 145-ish even, this is interesting. I'm not sure this is giving me the results I want. Yeah, it's still out of the money positions, but are farther out in time. Let me take a look at the option chain here. Let's go to just November 4th. Premiums are fine for the prices that we had in. It's just not showing any profit. Let's see if we can take a look at that. Let's go to calculators and go to Black Scholes. So that 138 at the money call, what would our profit be worth if the stock was trading at 144 on the 31st of October? So what it's going to do is it's going to run the dailies for us using the Black Scholes pricing model, Frank. On 1031, the price is $6.55 for this option. And the current price, the expected bid, is around $9, but the actual price is $6.80. So we would have lost money on that. That 3% movement with the at the money option did not give us the best return. And these further out here, we lost so much time decay on this position, they weren't profitable either. Okay, so we'd have to be probably here to see any profit, 136 or 135. It depends on your expected move on the underlying stock, Frank, and if that move is realized. That's really the answer to your question. Our experience has been in normal market conditions, maybe you're not hitting those profit targets you want to see, hitting for the fences with those out of the money options. But if you don't see the movement you want, you might not see the profits you want. And James' question is fair. I take a cheaper 149.205 strike. The option finder is calculating your expectations based on your target date and what you're expecting for the stock itself. But if I buy this cheaper $2 149 and Apple moves up to 142 in the next 2 days, it might be at $3 or $4. But as we go further on and further on, and 2 weeks away, I expected a 5 or 10% move. This is losing all of that time decay, and until it gets closer to intrinsic value, we're not seeing, at the money where we'd have the highest time value, or it goes in the money where we get some intrinsic value, you're just losing this return over the next 10 or 15 days. This was November 4th expiration, remember, so on the 31st, we're going to be pretty close to end time where most of your time value decay is gone. The Black Scholes model showed you that too. This would be your expected time value decay going forward for the call or for the put option as you head out in time. Okay, so long option finder. Very powerful tool to help you identify which option is going to give you the best bang for the buck if the stock hits your target price on or near your expected date. You can have fluctuations in between. Even changes in implied volatility could affect the price in or out, Frank. In general, though, as I mentioned, we've found that with normal market conditions, going one strike or just going at the money usually yields the best return. So Ernie's, not allowing it to go more than one strike out of the money. In these cases, a lot of times you see right at the money or just one strike out of the money. That's with the Bollinger Band default search. The initial values default search, you're going to see ones that are just about one strike or close to the stock price at the money, but one strike in the money. As again, we've seen those over time yield the best and most consistent returns for normal market movements. With that phrase, again, normal market movements, something that we haven't seen in a couple of years. All right, October 14th, we stayed at a light buy. Looks like we have 4 bears. I apologize. 4 bulls, no bears, and 9 neutral. And I think we were at 3 and 0. No, we're still at 4, 9. It hasn't changed yet. For the indicators, is anything close to going bullish? Percent of new 52-week stocks. Percent of new stock 52-week high versus 52-week low ratio is close. And SPX days over SMA 100 is close to going bullish on the fence. And of course, percentage of stocks over the SMA 100 is getting close to the bullish. So that might go up to 7 indicators Monday or on Tuesday.